let's bring in Scott Gecas from Longleaf Trading Group. He's live from the CME in Chicago. Scott, great to have you with us today. Trade fears, talk of global growth fears because of that weaker than expected jobs print, not to mention the rising rig count. We did see the oil price under a fair bit of pressure last week, down 4.4%. It does seem like we are watching oil trying to make up some ground after Friday's fear-based sort of market sell-off.
Yeah, that's exactly right. You know, with the weaker dollar and no retaliation from China just yet, that put a big lift into equities as well as the oil market. The weak dollar is adding bullish sentiment to oil prices right now. The trade war talks are still in effect. One thing that really sparked my interest was the reducing of the load from Saudi Arabia from China. So if they're reducing their imports from Saudi Arabia, they're still going to start having the imports from the U.S. They have the higher rig count. The sanctions on Russia are adding a little bit to the volatility in oil right now. But, as you can see, as of today, it was a much stronger move. You've seen the bulls come in, fresh buying. We're looking to test, if we can close above that 64 level in oil, it's going to be off to the races and we could test contract highs.
Geopolitical tensions, Scott, always seem to play quite a big part in oil moves. How is the latest conflict in Syria impacting oil prices right now?
You would have thought it would have been a negative effect, but it's really not. So it's adding pricing to the upside in oil. What is a weird correlation right now with oil prices is they're following the equity markets. Now that has a tendency to be very risk off, in the coming weeks going into earnings. And I was reading a report that the big funds are net short the NASDAQ in the largest level since 2011. So if tech can't move into higher space, you're going to see a big pullback in equities as well as you're going to see a pullback in oil as well.
Our earlier guest, Alan Nuckman, was actually saying he's expecting to see a turn perhaps for the energy sector, well, certainly as we head into earnings, but also looking at the oil price, which may be, looking to sort of gain a bit of momentum from here. Would you agree with that perhaps there is some value right now across, if we look at the energy companies, some of those on the broader market there? Do you think there is a turn and some opportunity right now across the space?
Yeah, and I think that you're seeing that just from the basic market movement just across the board. With the oil contract, you're seeing a heavy net long position in the underlying, but you're also seeing the put-call ratio jump to about 2 to 3 to 1 to the downside. There's a very heavy premium to be able to protect those long oil contracts with the puts to the downside. You're seeing about an open interest on the 60 level of about 22,000 just with 8 days left to go. So that is definitely saying that there is still risk involved in the oil market, and everybody is protecting themselves, looking for any adversity coming into play in the next few days.
Scott, let's switch across to gold. Obviously, with trade tensions, we've been seeing some safe haven buying, particularly in gold. So with that at play, that seems to be one of the primary drivers, along with the weakness in the dollar. Technically, I know a lot of our analysts have been saying that gold looks fairly strong. Are you expecting more gains for the gold price from here?
Yeah, for sure. On a technical level, I think gold is going to test, around that 1380 level. We have to break that 1360 level first, but that 1360 level, it's been touched about 4 or 5 times in the last 7 months. That just keeps testing it, pulling back, testing it, pulling back. Sooner or later, it's going to test it and just follow through. So that's what we're expecting on the technical side. The weaker dollar is giving, movement to the upside in gold as well.
All right, excellent. Scott Gecas, appreciate you joining us. Thank you so much for your time today.
Thank you.